In this video, I'm going to be going over an ETF that might be a better alternative to JEPI. Now, the JPMorgan Equity Premium Income ETF is typically seen as a high-yield ETF that is created to give investors income. Now, there's another ETF, DIVO or DIVO, the Amplify CWP Enhanced Dividend Income ETF. And this ETF offers a great combination of high income and capital appreciation. So it could be a better ETF to hold for income if you are looking for that appreciation. So I'm going to do a dive into this ETF and talk to you about how this ETF is structured, its holdings, and kind of somewhat compare it to JEPI. And before we begin, if you do appreciate this content, definitely leave this video a like to get this content out there, and also subscribe for future content. A bit of a high-level overview. The ticker symbol is DIVO, and it has about $3.1 billion in assets, which is quite a bit smaller compared to JEPI. JEPI has a total of about $33 billion in assets under management. So when it comes to size, DIVO is definitely a small ETF, about 1/10 of the assets under management of JEPI. The ETF has an expense ratio of 0.56, which is quite a bit higher than JEPI. JEPI has an expense ratio of 0.35. This ETF offers a much more narrow selection of stocks, which has 38 total holdings, compared to JEPI's 133 holdings. A bit about this investment strategy of DIVO. So DIVO is an actively managed ETF of high quality, large cap companies with a history of dividend growth, along with tactical covered call strategy on individual stocks. DIVO is strategically designed to offer high levels of total return on a risk-adjusted basis. So it holds high-quality, large companies that have a history of paying dividends, and then also supplements that income with covered calls on those individual holdings. Now, along with JEPI, this ETF does pay monthly, so a lot of dividend investors do look for that monthly dividend payment for that frequency of income. And the ETF has a current distribution rate of 4.84. This is a bit high for the dividend ETF size, especially when you compare it to other popular dividend ETFs like SCHD or VYM. This one offers about a 1.5% yield over those conventional dividend paying ETFs. A bit of a brief overview of the ETF JEPI for comparison. JEPI generates income through a combination of selling options and investing on large cap stocks, seeking to deliver a monthly income stream from associated option premium on the calls that it sells through exchange-linked notes and stock dividends. And the intent of this ETF is to deliver a significant portion of the returns associated with the S&P 500 with less volatility in addition to monthly income. And DIVO somewhat has a similar strategy. It also seeks to lower volatility. Dividend and option income may provide a lower share price volatility versus the overall market during times of broad-based market declines. So overall, both of these ETFs do have a somewhat similar strategy. They are both designed to pay investors monthly through distribution of dividend income and also associated option premium. But they're both designed to lower volatility, and they both hold a large cap or large companies. Let's take a look at the holdings of DIVO and how the weightings are associated with the ETF. As an ETF with these holdings, I absolutely love its holdings. It's definitely a broadly diversified portfolio with various sectors being implemented into the ETF itself. The good thing about this ETF is that no holding is so much outweighing another holding. Toward the bottom, you do get some variance, but definitely toward the top, the variance is less so. So if you look at the top 5 holdings, for example, you see a tight grouping of a Microsoft, Home Depot, Visa, Walmart, and United Healthcare. They all are in the range of 5%. So you're not going to have a particular holding outweigh another particular holding by that much. And even going down a few, you only see a variance of about another 1%. Overall, a very diversified holding, not only in weightings, but also in industry type as a whole. in comparison with JEPI, JEPI's holdings are even more narrow. There aren't many holdings that have a huge variance in the top 10. The number one holding in the ETF is Amazon, and that's at 1.74. And then if you go down to the 10th, you have Costco, which is 1.4. So this ETF provides a much better diversity as a whole, of course, because it has 133 holdings, and it also has a much narrower range of weightings itself. Now, about DIVO's approach to income, it basically gets 2 to 3% of the income received from dividends and an additional 2 to 4% from options premium. So it's pretty much equal split for the most part between dividend income and option income itself. Now, if we take a look at JEPI, it definitely gets the majority of the income received through options premium. And that is very important because the amount of income you receive is going to be a lot more variable. When you sell an option, it is basically priced determined by market volatility. So if the market is very volatile, your premium will increase. If it is not volatile, if volatility is low, then the premium will decrease. And the fund only gets 1 to 2% of the income the investor will receive from dividends. This is very important, I think, when it comes to basically how both of these ETFs operate. You're going to have a much more reliable dividend probably with DIVO compared to JEPI, because JEPI gets a lot more of the income from its volatile options that it sells through exchange-linked notes. So let's get into the dividend payments. That is probably what a lot of you are interested in, because most of the people that watch my channel, I assume, are primarily dividend investors. So if we take a look at this cash amount column here, you are going to see that dividend payment come in every single month. If you look at the payment date, it pays around the first week of the month or around the last, although it definitely looks like it's more so the last week of the month, probably the last day of the month almost. And you have the cash amount column going back to that. If we take a look at this dividend, you see there isn't much variance to that dividend payment there. So this is going to be a much more consistent dividend payment overall. Getting into the dividend of JEPI, it does offer a higher yield, of course, because the options premium is much higher in itself, but that dividend yield is a lot more volatile. Again, take a look at the cash amount and see how that cash amount changes. So going down, you see a much more volatile dividend payment. Going down, you see a much more volatile dividend payment. It jumps around quite a bit because of the higher reliance on that option premium. I don't think that this would be the exact best ETF to have if you are truly reliant on that dividend to remain the same. If you have $5,000 a month in expenses and the dividend decreases, then how are you going to pay your bills? If you look at an ETF like DIVO, yeah, it definitely pays less, but it is also more consistent with its payments. Looking at performance, unfortunately, neither of these ETFs date back that far. So this is only going to be going back to January 2021. I believe that is when JEPI debuted. And what I did was I put that in comparison to JEPI and DIVO, and I ran a back test of an initial balance of $10,000. And both of these ETFs pretty much performed in line with each other. There were some instances when DIVO outperformed, and there were also some instances where JEPI outperformed. Although DIVO, for the most part, if you look at the blue line, it definitely was outperforming probably more consistently than JEPI overall, although that is a very slight outperformance, all things considered. When it comes to standard deviation, DIVO had the higher standard deviation. JEPI is more tuned to decrease volatility overall, even more so than DIVO. DIVO had a higher max drawdown compared to JEPI as a whole. Both of these ETFs are probably great alternatives to each other in itself, although I do think DIVO may outperform JEPI over time because of the portfolio that it has. So to give you an example of what I mean by that, there is a similar fund, the JEPIX. It pretty much has the same strategy as JEPI. It is the mutual fund version of JEPI pretty much. It has been around for a little bit longer, since January 2019, so we get an extra 2 years of back testing, and you will see that DIVO definitely did outperform pretty nicely through that time. You would have gotten an extra $1,700 during this time compared to JEPI. Of course, the usual things are still the same. The standard deviation is the same in regards to how volatile each one were, and there was a slightly higher max drawdown for DIVO in itself, but nothing too crazy. I think the important thing to take away from this is that with JEPI, you're going to get lower volatility, and you are also going to likely get higher capital appreciation with DIVO. And going back kind of to solidify what I was saying about its holdings, DIVO will probably outperform. Again, because it does a tactical covered call strategy on each individual holding, JEPI basically uses exchange-linked notes, and they're going to drag down the performance of the portfolio as a whole. And on top of that, JEPI definitely does have a more diversified list of holdings, and that is great to resist against volatility. But because of that, you're really not going to get a kind of top-heavy method of growth here. You see a lot more growth-oriented companies, I would say, with higher weightings in DIVO than you do with JEPI. Of course, that is going to increase your volatility a bit, but it's not going to be too bad, and you're going to get that great income with capital appreciation as well. So that was an overview on DIVO. I do hope that you may consider it an alternative to JEPI if you want that capital appreciation more so than the dividend itself. Remember, if you did enjoy this content, leave this video a like and subscribe for future content, and I'll see you all in the next video.